Welcome to the Commerce Mentorship Program's online lecture series. My name is Richard and I'm the online tutor for Commerce 294, Managerial Accounting. Today, we'll be focusing on budgeting. I will begin by providing you with a brief overview of the subject matter, pointing out key formulas and tips that you will need to succeed in this topic. I will then guide you through some questions relevant to the course material. This is a good time to test your knowledge and understanding of the subject matter. Pause the video before I present the solution and attempt to complete the question on your own. You will know that you have mastered the concepts presented when you are able to complete the questions independently. However, it is good to remember that you should not measure your success on this video alone. Accounting requires practice, and the more exercises you are able to complete from your textbook and from your instructor, the higher your likelihood of success in this course. At the end of this video, I will review our goals and objectives for today. Your job is to ensure that you have met each of these objectives and fully understand them. If you have any questions at any time during the video, make a note of it and speak to your instructor or teaching assistant. Not everyone will initially understand the concepts presented today, and you may find that you require some assistance. Do note that this is perfectly natural. By the end of this video, you should be able to identify the purpose of preparing a budget, define the term zero-based budget, prepare a cash budget, and prepare a production budget. Budgeting is useful for a variety of reasons. It forces management to plan ahead. It provides information that can be used to improve decision-making, such as information about resources or materials, and it provides performance evaluation standards. A company can compare its actual results with its budgeted ones to see if it did better or worse than expected. It also improves communication and coordination among members of a firm. All employees and directors know what to aim for in a certain period and can all work together towards a common shared goal. It also forces departments such as production, sales, and marketing to all work together. It provides direction and guidance for the firm. Budgeting can allow companies to foresee problems and develop new policies. If they intend a large spike in demand, for example, they may be able to foresee problems with employee morale as a result of copious amounts of overtime, or so on or so forth. Lastly, it reduces frivolous spending. If a company is aware of what it should be spending, it can know if a director decides to charge a vacation to the company, or if severe overtime is happening within a certain period. Here's some key terms that you should be familiar with when determining a budget type for your firm. A zero-based budget is a method of budgeting that begins from scratch, ignoring whether budget projections are higher or lower than in previous years. In a zero-based budget, all expenses must be justified, and each function is analyzed for its specific needs and costs in the upcoming period. Zero-based budgets can be time-consuming, but allow top-level strategic goals to be implemented. A production budget calculates the number of units that must be produced in a certain period, whether that be quarterly or monthly. This is actually quite simple. You begin by taking the budgeted sales figures for the period you are budgeting for and subtract the inventory you have on hand at the beginning of the period. You then add on the amount of inventory that you are required to have on hand at the end of the period to find your required production for the period. For example, if we were budgeting for April, we'd take the budgeted sales for April, subtract the inventory on hand at the end of March or beginning of April, add the required ending inventory at the end of April to find the required production plan for April. Let's try an example. The Great Toy Box Company manufactures and sells Bratty dolls. Great Toy Box has forecasted the following sales for the next 5 months. The VP of Operations requires that month-end inventory levels equal 20% of the following month's sales. Great Toy Box has $20,000 in inventory left over at the end of December. The required here is to prepare a production budget showing the number of units that need to be produced each month from January to May. This scenario, we simply have to utilize the formula budgeted sales minus beginning inventory plus required ending inventory equals required production for the period. A reminder that the budgeted sales figures are given to us in the question. The beginning inventory on hand in January is also given to us in the question. The beginning inventory for the other months is the required ending inventory of the month before it, as this is the amount we are required to keep on hand as we go into the month following it, and is therefore our beginning inventory figure. The question states that we must keep 20% of next month's budgeted sales in ending inventory, and as such, this is our required ending inventory. From there, we can simply find the amount that we need to manufacture each month. Cash budgets really have three basic sections. A section where you calculate the total cash you have available, a section where you calculate the amount of cash you need, and a section where you calculate how much excess cash you have and what your ending cash balance will be. To calculate the total cash you have available, take the beginning cash balance at the start of the period and add on any receipts, which refer to cash amounts that you receive, such as sales, accounts receivable, and customer collections. This should get the total cash you have available to your company in the next period. To find the cash you need, aggregate all disbursements or payments. This could include items such as purchases, wages, utilities, advertising, office expenses, equipment, etc. To this, you add on the minimum cash balance, otherwise known as the amount required on hand at the end of the period. This should help you determine your total cash needs. The final section involves calculating your ending cash balance, which consists of any excess of cash available over your needs. You can determine the excess of cash available over your needs by taking the total cash available to you, Part 1, and subtracting total cash needs in Part 2. Let's try an example. Salmon Ella's is a fish distributor getting ready for its first quarter of the fiscal year. Salmon Ella's finished its last fiscal year with a cash balance of $75,000. Actual sales volume for the past 2 months, along with the budgeted sales for the next 2 months, are shown in the next slide. Salmon Ella's has been in business for the past 25 years and has discovered that 50% of a month's sales are collected in the month of sales, 25% in the month following the sale, and 10% in the second month following the sale. The remaining balance is considered to be uncollectible. Budgeted expenses for the first quarter include: Salmon Ella's pays for 50% of its purchases in the month of sale and the other 50% in the month following the sale. Salmon Ella's requires a new fish gutter that will cost the company $15,000. This will be purchased in March. The CEO has requested that the company keep a minimum cash balance of $20,000 at the end of each month. Our required here is to prepare a cash budget for the first quarter. The best way to approach a budget with multiple months is to go 1 month at a time. We begin by calculating the first section of the cash budget. As a reminder, the first section involves taking your beginning cash and adding any cash inflows or receipts to find the total cash available. In January, our beginning cash balance was $75,000. This was given to us in the question. Our receipts include collections from customers. As a reminder, 50% of a month's sales are collected in the month of sales, 25% in the month following the sale, and 10% in the second month following the sale. The remaining balance is considered to be uncollectible. This produces $372,500 of cash collections from customers, and a total cash available figure of $447,500. Next, we want to determine our total cash needs. Disbursements include purchases, rent and utilities, salaries and wages, transportation fees, and equipment. Add this to the minimum $20,000 the CEO requires us to have on hand, and we have a total cash need of $393,000. A reminder that our total cash available was $447,500, and our total cash needs were $393,000. This produces an excess of cash available over needs of $54,500. This is our ending cash balance. The end of the budget would look like this. The ending cash balance is the figure we use as the beginning cash balance for February. If we continue on month by month, our cash budget should look like this. This concludes our online tutorial on budgeting. Let's review our objectives for today. By now, you should be able to identify the purpose of preparing a budget, define the term zero-based budget, prepare a cash budget, and prepare a production budget. Remember to have fun. COMM 294 was the course that convinced me to major in accounting. It's a challenging but thought-provoking and fun course. For additional problems, please visit us online at cmp.cus.ca. If you have any additional questions, please consult your professor or teaching assistant. Thank you.